want to welcome everybody to this version of Managing Your Money. At Pekin Hardy Strauss. I'm Bill Pekin. I'm here with my co-hosts, Adam Strauss, Josh Strauss, and Matt Bloom. And we are going to talk about the topic of inflation, or as a nod to Dr. Strangelove, what I call how I learned to stop worrying and accept inflation. And I have been increasingly thinking that inflation is our future, at least our near-term future, because I'm not sure how else we will get out of this mess. I will just set up a fact and then open it up for discussion. Reinhardt and Rogoff, in their seminal book on debt, written around the 08-09 crisis, basically studied economies over the last 100 years, both developed and developing economies, and said that once for a country debt to GDP got over something like 110%, it was resolved in one of three ways, and only in one of three ways. And again, this is for both developed countries like the UK and developing countries like Greece. It was either through deflation, hyperinflation, or inflation. And today the U.S. is at depending on how you count the debt to GDP, but I've seen ranges of 120 to 130%. So we are firmly there, and it looks like we have three scenarios. Which scenario I am betting on, but I'm going to open it up. Does anybody want to discuss this pathway forward?
I'll jump in.
Go ahead.
I think that there's the long-term view, and then there's the path to get there. And I couldn't agree with your long-term view more. It seems to me like the only way out of this is inflation. And that seems to me to be the long-term direction that we're going. Billy, can you remind me when that Ken Rogoff book came out about debt and financial crises?
I think roughly sometime in 08-09,
Right.
Perhaps 2010, but around that period.
I think after the financial crisis, a lot of people could have and did come to the same conclusion that you just stated right now, which is the only way out of this is inflation. And yet the 10 years between 2011 and 2021 were not inflationary. They were maybe mildly inflationary, even disinflationary. And 2020 was highly deflationary. That's when oil prices went below zero for a period of time. So I think that I agree with your long-term view, and I probably would have said that in 2011. But I was early, and I didn't quite get the right path. You know, it wasn't an immediate, like, every year is going to be inflationary from here on out. There's like a pathway to get there. And I think that's maybe the question. Has the long-term now also become the short-term?
And if I can just interrupt, I think, and again, I just saw this is a stat from Luke Roman, who said that circa 2004 debt to GDP was about 60%. So I'm guessing that debt to GDP in the U.S. circa 2008-9 was 85%. I don't think we crossed that threshold. So one, I would say, per Reinhardt and Rogoff, we weren't at that level in 08 and 09, and maybe that's why the subsequent 10 years were different for us. Two is, it was, looking back now, a very disinflationary period. You're absolutely right. And the Fed pushed rates down to zero, and rates were negative in much of Europe, and inflation didn't stir. And that was head scratching for a lot of people, and central bankers thought that they had defeated inflation. And for a moment in time, the bankers were absolutely right. I think one of the things that some people have pointed out, particularly Gavkal, was that it was also a time of the shale revolution in the U.S., right? And so we forget that oil peaked around 2010 at $100, $105 a barrel, and then started the great moderation. To your point of oil going negative, it culminated in the negative oil price in 2020, but oil went from $100 a barrel to 40 to 50 from 2010 all the way through 2019, essentially, which is unbelievably disinflationary. Right. And now
100%.
I think that helped us. If you believe we're going to have an energy productivity miracle like that again, and maybe we will, then maybe the future is disinflationary. Or maybe you believe, as many people do, that oil will stay at $65 a barrel, whatever, and maybe that will make the future more disinflationary. But that was, I would say, the shale revolution was a once in a lifetime type of discovery. But so I'm skeptical is my point that what we did in the 2010 to 2020 period, that largely disinflationary period, will be done again in this upcoming period.
One thing worth thinking about inflation is inflation is higher prices year over year for the same goods, supposedly. And there were a number of things that happened over the 2008 to 2020 timeframe that kept to keep inflation in check. You mentioned one, which is the Great Shale Revolution. Another might say that there was a lot of inflows into the U.S. capital markets because of the advent of the smartphone and corollary technologies associated with that, which was really led by the Mag 7, let's call it. I mean, not all of them, but some of them. And much of the Europe was in a productivity morass, and so the dollar has been quite strong from in that time period, surprisingly. And so that helped to mitigate the enormous amount of government spending that might have started the fires of inflation over that time period. Now, today, we look at other technologies that might have kept to keep the dollar strong. The Shale Revolution is largely played out. You haven't seen the downside of that and whether or not the lifetime of these wells were supposedly a lot less than traditional wells. You could see a quick drop off. So we still haven't seen the benefits of that. The smartphones are mature. Some might say the AI revolution could add another one, and that may well be. But my impression of the AI revolution is that this is not a U.S. phenomenon, that it's going to be a global phenomenon. China, Europe, and elsewhere are all racing very fast to try to develop new technologies here. So there's no exceptional new item, technology, or other sort of phenomenon that to help keep the dollar strong. And so that also the reversal of that could also cause inflation just by the dollar getting weaker as a result of that.
Yeah, the one thing also that hasn't been mentioned is globalization and lowering of labor costs with China and other emerging markets providing a lot of that low cost labor. A lot of that has not only played out, but we're seeing the early signs of that reversing as well with trade wars and tariffs and that sort of thing. So as you take out that significant supply of lower cost labor, that also should take away one of the significant forces that help to keep inflation from rising during that 2010 to 2020 period. But I wanted to directly answer Bill's question where he said, which of the three paths, default, it's hyperinflation, or it's extended lower level inflation? I think default is off the table. The United States has no intention of actually outright defaulting on its debt. I also wouldn't expect hyperinflation in the United States. That's typically associated with a complete and total failure of the currency, where all faith is lost in the currency. And I think that the preferred path, the path of least resistance, is going to be that extended period of moderate inflation. And that's the one that's been used before in the United States and other developed countries historically. And I think it's the one that the United States will pursue, it is pursuing in the current scenario.
If I could just jump in, Matt, I think moderate inflation seems unlikely. When you say it's recurring, we're currently pursuing, we currently do have moderate inflation, no disagreement there, but it's not working to reduce the debt to GDP ratio. The debt to GDP ratio goes up with moderate inflation as it is right now. Like the only time in the last 10 years where the debt to GDP ratio has taken even the least bit of a step down was in 2022, I believe, when inflation got up to 9%.
Fair point. The moderate inflation has to be paired with low interest rates for debt to GDP to have any chance of declining. You have to make sure that your debt increases at a lower rate than your GDP does. So there's a couple pieces there. So maybe inflation needs to be higher than it is now, right? Maybe it needs to be the near 10%. I don't know, but it also has to be paired with interest rates that are kept artificially low by the central bank, because obviously if they're left to float, they're going to rise with inflation. But in order to bring debt to GDP down, you have to have artificially low interest rates as well.
You raise a good point that I wanted to get to, Matt, about how much inflation is good and how much is bad. I do agree that in order to get your debt down, you have to inflate away that debt at a faster rate. And I want to show some charts here that explains what that illuminates our predicament, or might be a path that we go down, and what might happen to us in this new inflationary world. And this chart is from Luke Roman, who I've referenced earlier, who basically used the experience of the UK. Josh mentioned the weak dollar, and he's exactly right. And preying upon my mind is while the dollar was strong, to Josh's point, and to Adam's point, during that 2010, 2020-ish period, the dollar has begun to break down under Trump's presidency. The dollar's down, I don't know, 8 or 9% this year, which is a big move in currency terms. And it's looking like that move will gather a pace as foreign capital begins to leave the U.S. for various reasons. As if we are de-dollarizing at the margin, and I would argue that we are de-dollarizing at the margin, everybody gets all huffy about the U.S. losing its reserve currency status. I'm not making a call on that, but I think at the margin, people are, as long as they can increasingly buy their commodities or oil in their own currencies, there's at the margin less of a need for dollars, and that is happening today in a way that has never happened before, pre-2022 at least. And what I'm going to show you is a chart that showed what happened to the value of the British pound once the UK lost reserve currency status circa World War II, at the end of World War II, and what happened to consumer prices in Britain during that period. Let me share my screen for a second. You guys able to see my screen?
Mm-hmm.
Yeah.
Yes.
Let's make it a little bigger, though.
I will. Okay. What Luke shows, and he did this about 2 weeks ago around the death of Stan Fisher, who was a former chairman of not chairman, but a member of the Federal Reserve Board. And so that's why there's this little call out here. But he basically said, hey, this is an interesting chart. It only goes to 2011, but it looks at basically the value of the pound during the creation and height of the British Empire until its decline and subsequent decline. And of course, you have the value of the British pound as it is the world's reserve currency, or the developed world's reserve currency, certainly circa 1750 at the height of the empire or the ascension of the empire. And you can see how it's so stable for 200 plus years, incredibly, right? And then after World War II, as things fall apart, and as the sterling gets replaced by the dollar as reserve currency, you see the value of the dollar crashes. The value of the pound crashes. To Josh's point, if you're worried about a weaker dollar, and if the pound is in a canary in the coal mine of what might happen if the U.S. loses its reserve currency status, and it doesn't even need to lose it entirely, as the pound did in this case, but if it loses marginally, maybe the result will not be this much of a decline in the dollar, but the direction of the dollar is likely downward, which is really my point. And I think the other point, which kind of shocked me, is, but it makes sense, is what happened to retail prices or a version of consumer prices in the UK once the UK lost its reserve currency status. And you see again from 1750 to World War II, prices in the UK are incredibly stable because the pound was overvalued because it was the reserve currency of the world. And of course, that falls apart as the dollar replaces it, and you see an incessant rise in consumer price inflation in Britain. And that is, of course, my worry about what may happen in this country if we de-dollarize at the margins.
That pound chart you're showing, is that the pound relative to other currencies? Is it relative to gold? Is it relative to the cost of a man's suit? Like, just trying to figure out how that was measured going back to 1750.
I don't know. It's a good question. There's no more info here than the value of the pound in log scale.
Okay.
So I don't know how it's being calculated. If you've actually looked at the value of the dollar over the last 100 years, the chart is pretty similar.
The chart would look very similar, I think, to this.
It would. Yes, it would.
And I think this chart starts to slide not after World War II, but after World War I. And I think that's when everyone, because of the war, went off the gold standard. So it was, I think, flattish for a long time because the pound was, and all other currencies for that matter, including the dollar, were tied to gold. And I think that ended after World War I, and that's when everyone was just printing as much fiat as they needed in order to pay their war debts.
I think you're right. I think that the UK, I think they devalued their currency after World War One. I think relative to gold. I think the pound was devalued. I think the dollar was as well during the Great Depression. I think that's how they got through some of those economic crises. So yes, that's a good point, Adam. So that's what this first dip is here.
Yeah, I think the United States waited until 1933 to devalue, and everybody in Europe was doing it earlier than that.
So, correct. That's correct.
Yeah.
This maybe is an extreme example. I'm not here to scare people, but I thought the direction is what I was interested in, right? And so the direction of the dollar is likely going to be downward. Again, this, to Adam's point, if you looked at the dollar chart of the value of the dollar over the last 100 years, it would be very similar to this chart of the pound. And I don't know what retail price inflation would look like in the US over this same period, but I suspect it's probably not very different. But again, it's a matter of degree. And I think that the degree is, if we de-dollarize at the margin, it's probably inflationary because, as Josh talked about, the dollar should get weaker and weaker. But before I give up my screen,
I interrupt and just say something. I think what do you take from this chart? The moral of the story is don't hide your dollars under your mattress for the next 250 years. But also, even in a shorter period of time, just playing it safe by holding your cash in a savings account or in a deposit account is foolhardy in an environment where you're going to see potentially significant depreciation of the currency.
That's a great point. I was going to get to that later. And while you're on that point, I have a chart for that, because what I wanted to discuss was the impacts, the potential investment implications of inflation, which I was going to save to the end of the conversation. But since you've served this up to me, and I already have my screen being shared, I'll, for the sake of expediency, show you this chart now. And to your point, I think the question is, if we are in a more inflationary environment, how much is the question? And we'll get back to that. But what are the investment implications? Let's see if this is the right chart. No, sorry, I'll get to that. Sorry. No, I'll get to that too. Sorry. Okay. I got it in the wrong order, but here we go. This again is a Charles Gove chart. Who I love Charles Gove, and what he shows here is, if you look at, he used central banks as a proxy, and if you looked at the basic Western central bank portfolio, the average Western central bank portfolio, it was 60% by and large U.S. Treasuries and 40% Euro bonds. But it was some combination of euros and dollars, essentially. And those were or have been the kind of risk-free assets. And we've all been taught that Treasuries in particular, and even euros, are risk-free assets. And he looked at this against an alternative portfolio of what if the central banks, instead of doing this kind of classic 60-40 treasuries, Eurobonds, had a 2/3, 1/3 allocation of Chinese government bonds instead, and gold. Now, again, I'm not recommending Chinese bonds here. That's not really the point. And maybe I don't think this would be very different if you actually took the Chinese government bonds out and had this be 100% gold. But what he's basically saying is, to Adam's point, in this inflationary world, which really started post 2020, that you can see the breakdown. Really, it gathered pace in 2022 with the Ukraine war, but you really see the breakdown of this formally stable, anti-fragile Western sovereign wealth bond portfolio, which was doing its job up until the great inflation in 2022. And this 9% inflation that somebody mentioned really began to destroy this perfect anti-fragile portfolio, which is not doing its job anymore of being anti-fragile. You've now, in real terms, lost 1.7% a year, or 25% in total over the last 15 years or so, which is horrible for a supposedly safe asset. And on the other hand, if you'd invested in what might be the new proxy of a safe government bond asset, which might be Chinese government bonds, but again, I'm not opining on that today, some combination of Chinese government bonds and gold, you'd be up 2.8% on a real basis, or up about 59% in total. That's a shocking bifurcation. And to me, it means that what Adam was saying is, if you're going to hold cash, if you're going to hold Western sovereign bonds, they're not going to protect you against inflation. Likely.
Agreed. That's what our investment strategy is right now, is to not be invested in those asset classes because we're perceiving that the next 10 years are going to be similar to what we've seen over the last 10 years in that red chart.
Yeah. Yeah. So I guess for me, the first wake-up call is if our future is inflationary, if we have these three scenarios that Reinhard Rogoff outlined, I think Matt is correct. I would doubt that we aren't going to default because our debts are in a currency that we can print, so that's off the table. I don't think hyperinflation is likely our future. I think it's likely going to be inflationary to some degree. And if that's the case, the investment conclusion is the very worst place to be in this environment is cash and bonds. Now, that's not to say you can't have some cash as a diversifier in the portfolio or some short-term bonds as a diversifier. A 40% portfolio of traditional bonds with a 4 or 5 or 6 or 7 year duration is the exact wrong place to be because you're going to get returns after inflation that look like this. Before I open it up again, I'll just because I'm sharing my screen, I'm going to go to the question that Matt brought up about how much inflation. Again, this is a Charles Gov chart. Thank you, Charles. And I thought this was just fascinating. And this is the big question and a large unknown, a big unknown out there, which is how much inflation are we going to get? Someone referenced the 9% inflation that we saw in 2022. Is that our future? And what Charles Gov did is he looked at over 100 years of data, perhaps going back to 1871, so well over 100 years of data, and maybe 150 years of data of inflation in the U.S. and the impact on U.S. stock market prices. And what he found was, which is to me fascinating, I don't get out very much, so this is fascinating, is that inflation between 2.5% and negative 2.5%, or I would say deflation of negative 2.5% to inflation of up to 2.5%, is actually ideal for markets. And that's like the sweet spot for markets. And you had the best U.S. market return in a kind of moderate inflation or disinflationary environment. And then what's interesting is stock market prices or performance begins to break down, particularly at 5% inflation or 5% deflation. So you get your tails when inflation or deflation get extreme.
It's interesting how this chart is normalized. It looks like a normal distribution, given the fact that the CPI being negative 10%. I don't even know when that would have been, but I would have thought that would have been more of long tail to the right, but it obviously isn't. And it makes a lot of sense.
1971, so there was a lot of deflation in the early part of that period.
Yeah,
I guess that's right.
Yeah, and in the Great Depression, it was deflationary too. I don't know to what degree. I'm not an expert historian at that time, but it was deflationary.
This suggests that you're not going to be able to protect yourself from inflation very well by owning the stock market.
And that goes back to Matt brings up the question, how much inflation, right? If inflation can stay moderate at this 2.5 or 3% level, then stock prices should do fine. If it gets, if we surge again above 5% for a period of time, that's exactly right. I think I think the stock market is not going to protect you. It's likely going to be certain parts of the stock market. If the 70s are any indication of what will protect you, and I'm going to get to that last chart, and then I'll stop sharing my screen. It looked like when we got to that over 5% level in the 1970s, it looks like only some things protected you. It was largely value stocks, at least in the US, and commodities, certainly oil in the 1970s that may or may not hold going forward, and gold miners helped you. So it wasn't that you couldn't make money in stocks in the 1970s or during a stagflationary environment or in an environment where inflation was high. It was certain stocks protected you.
You couldn't make money owning the broader S&P 500 index.
100%. That's 100% right. But you could in certain stocks, is my point. So I don't want to say abandon all hope about performance inflation. No, there is hope. There is a strategy. And so let's get to this last chart. And
this is for being selective.
I'm sorry?
It's the time for being selective about stocks.
Exactly right. Exactly right. This is Jeff Gundlach's presentation from a week or so ago called Surreal, and he looks at inflation today versus the 1970s, and this gray line is inflation from 1966 to 1982, and the blue line is inflation from 2014 until today. You can see the years here both, and you can see shockingly the 1970s is almost, at least so far, a perfect analog for what is happening today. This is the major inflation that happened in the early 70s and that happened in 2022 that Matt referenced. And now we've seen a moderation of that. The question is, are we going back to this, which is what really convulsed the market, right? The first market convulsion in the early 70s, or the first decline of the Nifty 50 growth stocks happened in here, but you saw a strong market rebound after inflation moderated. And then you had the really major convulsion of the stock market in the latter part of the 70s as inflation came roaring back, only to be defeated by Paul Volcker. The question remains is, are we going to see inflation like that again, or is this chart going to moderate or go lower? But if this analog holds, and we're going to go back to 2022 levels, right? We've seen it. It's not impossible. It happened 3 years ago. In 2022, as Adam was saying, only select stocks did well. It was really only energy stocks, resource stocks, and gold that protected the portfolio in 2022 as it did in the 1970s. I would suspect that would be similar this time around, but I'll open it up to you guys.
I'd like to start with a kind of a key caveat here that we haven't discussed is the CPI is defined by the Bureau of Labor Statistics. And they are constantly rejiggering what's in it and changing weights and what have you. They have a significant interest in keeping CPI low, and they being the government, because it lowers Social Security payments, it lowers other things, and keeps the world thinking that inflation is not necessarily as bad as it may well be. And they've been more aggressive in manipulating the CPI as compared to history. So you might not necessarily see the same kind of CPI spike that you would have, because it certainly feels like inflation, and this is obviously anecdotal on my part, that inflation feels a lot higher than what the numbers have been over the last couple of years. And so, how it reflects in the CPI and then its impact on the S&P 500, we don't necessarily quite know, given the fact that the CPI has been so manipulated over the years.
Yeah, I think that's absolutely right. I think the CPI has been influenced by or managed by the government authorities. I think Lawrence Subner said if you calculated CPI in the same way that it was calculated in the 1970s, then current CPI would be 17%, at least at one point in the last year or so. So it has been managed downward. But even with that, Josh, we still got 9% in 2022, even with this contorted number. Well, I'm going to get back to and put a pin in that manipulated CPI number. Is one of the items I want to get to in a second. But yes, you're right. It has been massaged down by the government, and I think they've done a good job of keeping the lid on official CPI. But we were in high single digits just 2 or 3 years ago.
Right. It's an excellent point.
I will. Any more comments before I get to Josh's point about CPI?
I guess the only point that I would make is that we're comparing the current chart to the 1970s. While inflation was high in the 1970s, it didn't need to be high. The debt level in the 1970s was not crazy like it is today. It happened in the 70s. It happened maybe for other reasons or whatever, but right now it has to happen. And so to me, if you looked at the scales of that chart, it suggested that even if it goes back to the peak that happened in the 1970s, because the left-hand scale and the right-hand scale are different, that the CPI will not be as high during this period as it was in the 1970s. And I would argue the other side. I would argue that by the time this is done, the inflation that we're going to experience is going to make the 1970s look like a cakewalk, because we have so much debt that we have to inflate out of. And so you either need to have inflation be at its 1970s level for a much longer period of time, like that, just going up to that one peak that showed in the 1970s and then coming back down. That's not going to do it. That's not going to solve our debt problem. You need to either have it be a peak and then a multi-year plateau at that peak, or you need to have a much higher peak if you ever want to have a hope of getting the debt to GDP down to a manageable level. And I don't say that as a prediction, like I have some kind of a crystal ball. I'm just like thinking about the math in my head of what's actually necessary to get the debt to GDP down to a regular level.
Yeah, I think you're absolutely right. And I think again, I'm not an expert in economic history in the 1970s, but I think what happened in the 70s was an oil, right? What spiked, you had the OPEC, you had wars in the Middle East, you had the OPEC cartel, and you
Excess
had oil
deficit
going,
spending too.
right, right, deficit spending from Vietnam, but you had oil going circa 1970. Oil, people don't realize this, oil went from roughly $3 a barrel circa 1970 to $30 a barrel by 1980. That's a tenfold increase.
Right.
Imagine it, tenfold increase.
Right.
That's like oil at 65 going to $600 a barrel. Like we don't realize once you put it in those terms, you realize the magnitude of what that would do. Now, again, I'm not predicting that type of super spike of energy prices that will lead to that type of inflation, but there are other things happening to keep this environment inflationary, as Adam is saying. And that's a good segue to the last thing I'll share is I think the official CPI number has been managed lower, contorted lower to benefit the government and COLA programs in the government. And I think the real inflation that we're experiencing, as Adam is hinting at, is much greater than this 2.5% or 3% number that the government's reporting. It's something a lot higher. And there's a website called the Chapwood Index, which is free to everybody, which is run by, I don't know if they're a non-for-profit or for-profit, but an independent organization which basically tracks 150 household items that most Americans or the average American spends their discretionary income on in the 50 largest cities in the US. So basically, it's tracking what, instead of the CPI number, which is this contorted number based on rents and housing equivalent and all the stuff that the government does, what the Chapwood Index does is basically look at the basket of goods that most American households are buying in large urban areas and then sees how the prices of those goods are changing. So let's go to this real quick and see what this independent organization, apolitical, my understanding, says about inflation that we've just experienced. And everyone see my screen? I can't make this bigger, but you can see this is chapwoodindex.com for those of you in the audience who want to go on your own to the website. And you can see it says right here that it's just reporting the actual price fluctuation of the 150 most bought items in which Americans spend their after-tax dollars in the 50 largest urban areas in the country. And let's just take the first row, and it basically reports this annually, and it breaks it down by city. You can go in a lot more detail. I'm not going to spend time with it now. Let's just look at the headline number. Let's just take New York here, and you can see that in calendar year 2022, the inflation number was 15.57%. In calendar year 23, that was the peak of inflation that Matt was getting at. It was 10.6%. And last year in calendar year 24, it was 11.6%. And the average of 3 years is 13%. That is a stunning inflationary number. It's stunning. And it's really not very different by city. Yes, there are differences, but by and large, you're seeing every city over the last 3 years. In other words, it wasn't just a 1 year 2022 Ukraine war spike. It has been a 3-year long average annual prices are going up by low double digits per year over the last 3 years. And the reported CPI, to Josh's point, is, I don't know, 2.5, 2.7, whatever it is. But real Americans, and that's why people are feeling cost pressures. That's why you feel like expenses are going higher, because they are. And that goes really back to ultimately what Adam was saying originally, which is if you get 4% in your bonds or nothing in your cash or 3%, you're not going to beat inflation in real terms, particularly if inflation is rising in double digits, or if Adam suggests if it even goes a lot higher, which is possible. I'll stop there.
And it's one of the things that I think people often, they feel it, but they don't think about it consciously, is that inflation is cumulative. And so even if the rate of change declines, right, and the Federal Reserve, quote unquote, gets inflation under control, it doesn't erase the inflation that we've felt over the last several years. Now, again, we go back to, I don't expect the Federal Reserve to get inflation, quote unquote, under control, because I don't think it's in their interest. As we're discussing, it's a feature, not a bug, right? They need inflation to run hot, again, in conjunction with low interest rates in order to bring debt under control. But from just a personal standpoint, what I think a lot of people feel is the fact that inflation has been high for the last few years, and it has accumulated. And even though that rate of change has come down from that peak of 9% CPI, we still feel like inflation is much higher than the CPI suggests that it is, partly because it probably is higher, but we're also feeling the effects of the last few years where even the CPI was higher. Cumulative inflation is a problem in addition to the go forward inflation. So I was just reading an article about how that's really what consumers are feeling, is that cumulative inflation over the last few years. And so I think people need to brace themselves for more of the same, possibly worse.
I think that the cumulative inflation that you mentioned is to a certain degree reflecting itself in our political process too. There is an argument that one of the primary reasons why Donald Trump was elected was because of, the Americans believed that he would get better control over inflation than what had happened under the Biden administration, and Kamala Harris had gotten some blame for that because she was in the Biden administration on the one hand, and then just today, I'm going to pronounce his name wrong, but this Democratic mayoral candidate for New York City, part of the reason why he actually won over Cuomo was because he had promised to make changes and putting more public assistance to make housing cheaper in New York City, because life is really expensive, right? Both on the left side and the right side, you're seeing this reflecting itself in our voting. And then one of the other things that I was thinking about that I wanted to ask you guys about was, since the 70s, the economy has changed a lot. It's a lot less product intensive, a lot more service intensive. And does that have a role with regard in inflation because of the nature of how the economy has changed? That we're better able to handle it? Are we less able to handle it? I don't have my arms around this.
If you believe the current administration, the U.S. economy will become more product dependent going forward. That's at least the stated goal of some of these trade barriers being put in place to increase the U.S.'s role in manufacturing a lot of the goods that we do consume. I do think that service inflation, I have no data to back this up, but I'm just speaking anecdotally. I feel like service inflation kind of lags product inflation, but I don't know if there's any truth to that. But if the US really is pursuing a strategy of sort of reindustrialization and bringing production of a lot of those goods back home, then I think you could, first of all, that in itself is inflationary because the US's costs are considerably higher than where a lot of those things are produced now.
Yep.
And so I think you might see, at least to an extent, a return to, or at least moving back toward the type of economy that we had 30, 40, 50 years ago, where we do produce more than what we have in the last couple of decades. But if there is any of that, it will be at higher costs.
Yeah, I think Josh raised a good point about services versus goods. Certainly, China has been the major deflationary force in this world, and many goods, I would argue, are cheaper today than they were before, thanks in large part to China. If you look at the average, what you spend on TVs or computers or whatever, most of the prices and clothing have gone down over time. It's gotten cheaper and cheaper to produce all those goods, all those items. On the other hand, a lot of critical services that aren't subject to international competition, like education in this country, or aren't subject as much, or healthcare in this country, have just gone up and up. I would say the critical for the leading forms of inflation in this country tend to be services inflation, perhaps because they can't be produced more cheaply elsewhere, for now at least. And a critical question will be, to what extent will we have globalized free trade in the same way that we had in the last 25 years that will give us deflation or the benefits of globalized deflation, or if trade walls and trade barriers are coming up. In other words, China's producing cars that cost $14,000 or $15,000, but yet we can't buy them in this country. You can't buy them in Europe. And so those deflationary benefits might not come to this country for trade barrier reasons. But on the other hand, there is certainly a scenario where, to get to your point, Josh, that maybe AI is so disinflationary that maybe it gets to some degree, it starts attacking those services inflations, and because AI just changes everything and becomes a tremendously disinflationary force in a way that wasn't possible. And maybe that is, I was going to say, the one thing that's out there that could act as a major disinflationary force in the same way that the shale revolution did 14 years ago is the advent of AI. And maybe that makes things so disinflationary that solves our inflationary problems. But we'll see.
And on the other hand, if you have all these trends that mitigate inflation so that inflation is low, then you never get out of your debt to GDP problem.
Exactly.
So again, I'm not saying inflation is a good thing, right? But it seems unlikely that we're going to get out of this just from productivity growth.
That's exactly right. And I would say this, I'm not going to get into politics, but it looked like Doge was an attempt at austerity and cutting government spending, a way to try to curb the inflationary impulses of the government that failed at a spectacular level. And it looks like now the government's focus is on to grow our way out of our problems, which is going to be inflationary. So again, it looks like there is an appetite in this country and most Western countries for austerity, for a disinflationary or deflationary type of program. And therefore, to Adam's point, the only real way forward, the only plausible path forward politically and culturally and socially for most of these societies or democracies is to inflate our way out of this. And that is why you're seeing consumer prices, as I showed you via the Chapman Index, at 12, 13, 14%. Maybe that's why you're seeing certain election results. How society deals with the inflation is unclear, but we as portfolio managers are concerned about protecting the portfolio. And I'll just sum everything up by saying that the TLDR is basically, if you believe Reinhardt and Rogoff, there's one of three ways to get out of our debt to GDP situation today. It's default, hyperinflation, or inflation. We basically said the first two are probably not tenable, so likely it's going to be inflationary. And then the big question is how much inflation? And as we've shown before historically, anything between the goalposts of -5 and -2.5 and +2.5 is really good for equity markets, but things begin to fall apart at anything between -5 and 5 and greater. And then you're in a kind of 1970s stagflationary or superinflationary environment. And historically, at least, only certain elements in the portfolio protect you, namely commodities and gold and hard assets. And that's what our focus is, to protect the purchasing power of your portfolios.
Yeah. I just want to add one quick point, Bill, because on that topic of where the sweet spot is, right, with inflation, I ran across some data recently that talked about how above 5% of inflation, not only do we see equity markets, that's where things start to break down. That's also where the correlation between equities and fixed income turn positive. So basically, above that 5% inflation range, you don't get any diversification benefits by owning bonds in your portfolio, because as we've been discussing, bonds become a bad place to set your money because you're losing in those real terms. And so you can't rely on at least broad equity markets. You can't rely on the fixed income portion of your portfolio. And so you have to be doing something different, right? You have to be going into other asset classes like precious metals or things like that. You have to be selective within the equity sleeve of your portfolio because the broad equity market is unlikely to protect you. And so it creates a much more complicated investing environment where you can't rely on the standard 60-40. Bonds will protect me here and equities will protect me here, because the data are pretty clear that the correlations turn positive and significantly above that sort of 5% threshold of inflation.
I think that's a great point. I think that's what shocked people about 2022 was that it was, I think, only the third time in the last 100 years that both stocks and bonds were negative in the same year of like above 5% each or something like that. Like the threshold was high. So 2022, when equities fell apart because of this high inflation, bonds did not save you at all. In fact, I think the bond market was directionally down 5 to 8%. You don't quote me on that, but directionally. And so there was no
I'm going to quote
anti-fragile
you
asset.
as being wrong. It
Was
was
that?
double digit. It was
It was
double
double
digit.
digit. Okay, was it down
Yeah,
13%? It was, or
1% is my
perhaps,
memory, but
yeah, it could be right. Maybe that was it. Maybe there's only three times in the last 100 years that bonds and stocks were both down in double digits. One was 2022. To Matt's point, when inflation was over 5%, it was 9%. One, I think, was in the 1970s, I think 73, 74, during that second inflation hump that I showed you in that chart. And I think one was in the 1930s, but I'm not sure what's going on there. But again, it's unusual. But to Matt's point is, yes, there's nowhere to hide, historically at least, if inflation gets above 5%.
yeah, the Bloomberg Aggregate Bond Index was down 13.3% in 2022.
All right. It's even worse than I thought, right?
It caught a lot of people off guard because they were relying on that fixed income sleeve of their portfolio to protect them when equities got rough, and it didn't serve that purpose. And I think people need to be aware of that going forward. The data are clear on that historically.
We're about at the hour. I think that's enough. Thank you for your attention, and we look forward to bringing you further episodes. Thank you.